Ladies and gentlemen, good day and welcome to the India Shelter Finance Corporation Limited, a conference call hosted by ICICI Securities. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Renish Bhuva from ICICI Securities Limited. Thank you and over to you, sir.
Yeah, hi. Thank you. Good morning, everyone. Welcome to India Shelter Q4 FY-2025 earnings call. I will now hand over the call to Mr. Rahul for the management introduction. Over to you, Rahul.
Thank you, Renish. Good morning, everyone. I take this opportunity to thank ICICI Securities for hosting our call today. I extend a warm welcome to all the participants on our Q4 FY25 earnings conference call. I hope everybody had an opportunity to go through our investor presentation and press release uploaded on the stock exchanges. We have also uploaded the Excel fact sheet on our website. With me today, I have Mr. Rupinder Singh, MD and CEO, Mr. Ashish Gupta, our CFO. I now request Mr. Rupinder Singh, our MD and CEO, to brief you all about the company's performance. Thank you and over to you, sir.
Thank you, Rahulji. A very good morning, everyone. On behalf of the company, I extend a warm welcome to all of you. Thank you for joining us on the call today. Looking back at the past year, I take immense pride in sharing our progress and achievements that have marked our journey towards responsible growth. India remains a land of boundless opportunities, where rising aspirations for home ownership and increasing financial inclusion are shaping the affordable housing finance sector. As a company committed to making home ownership accessible to underserved communities, we have reinforced our foundation by fostering trust, driving efficiencies, and creating meaningful impact. Demand for affordable housing finance continues to accelerate across Tier 2, Tier 3, and fast-growing micro markets. Rising disposable income driven by expanding job opportunities in various sectors are reshaping consumer aspiration in these regions. On that note, let me move towards the quarterly update. We are pleased to announce that the company delivered strong operational performance in the fourth quarter of financial year 25, driven by demand environment in affordable housing segment. We delivered an AUM growth of 35% year-on-year, reaching an AUM of rupees 8,189 crores. In Q4 financial year 25, we disbursed rupees 933 crores, registering a growth of 25% year-on-year. Whereas in financial year 25, we disbursed rupees 3,335 crores, registering a growth of 25% year-on-year. During the quarter, our branch network expanded to 266 branches in total, and during the year, we added 43 new branches as per the plan. On profitability metrics, PAT for the quarter came in at rupees 108 crores, registering a growth of 39% year-on-year. This is the first time that we achieve PAT of more than 100 crore in a single quarter. Return on assets came in at 5.8%, and return on equity further improves to 16.3%. Again, this is the first quarter post-listing where we delivered the ROE above 16%. Our net worth now stands at rupees 2,709 crores. Further, we continue to maintain a guidance of branch addition of 40-45 for the year, margins around 6%, credit cost around 40 to 50 pips, loan growth of around 30-35% to reach AUM of 30,000 crores by March 2030. Lastly, as we remain committed towards sustainable finance, the board has approved the ESG policy. Through the implementation of this policy, we seek to achieve a sustainable future for our stakeholders and future generations. Now I would like to hand over call to Mr. Ashish Gupta, our CFO, to take you through the financial metrics. Over to Ashish.
Thanks, Rupinderji. Good morning, friends. Let me take you through the key financial numbers. AUM as on March 25 is 8,189 crore. Year-on-year growth in AUM is 35%, in line with our guidance. Quarter-on-quarter growth in AUM is 7%. Total income for quarter is up by 34% year-on-year, largely driven by 35% growth in AUM. Quarter-on-quarter total income is up by 8%. Our portfolio yield is stable at 14.9%. Disbursement yield for the year is 15% versus 14.9% in previous year. Our bucket cost of fund is down by 10 basis points in Q4 to 8.7%, driven by lower marginal cost of fund at 8.6% in Q4 and reset in few of our borrowing linked to repo rate. Share of NHB funding is stable at 15% year-on-year. We have undrawn sanction of 200 crore to be drawn in Q1 FY26. With this, our lending margins are up by 10 basis points to 6.2% and are consistently above 6% in line with our guidance for medium term. On liquidity side, we are comfortably placed with liquidity of 1480 crore, including undrawn sanction of about 900 crore. Our ALM is positive across all the buckets. Net income for the quarter is up by 33% year-on-year basis and 6% up on quarter-on-quarter basis. On interest rate risk side, we have been able to bring down the percentage of fixed rate portfolio funded by variable rate liabilities from about 45% last year to about 18% this year. We are committed to further reduce this in coming 12 to 18 month time. Coming to OPEX, our year-on-year growth in OPEX is lower than growth in AUM, resulting in better cost ratios. OPEX to AUM for the quarter is down by 10 basis points quarter-on-quarter and down by 20 basis points year-on-year. On asset quality side, DPD 30 is at 3.1%, down by 60 basis points quarter-on-quarter. Stage 3 is at 1%, down by 20 basis points quarter-on-quarter. With improvement in asset quality, credit cost for the quarter is 20 basis points, and for the year it is at 40 basis points, which is in line with our guidance. PCR for stage 3 asset is stable at 25%. Our total ECL is 64 crore against the regulatory threshold of 37 crore. Adequate provisioning buffers are in place. If you look at our BT out rate, it is stable below 6%. On PAT, we have crossed the important milestone of 100 crore a quarter on the back of strong volumes, margins and credit cost. PAT for the quarter is 108 crore, year-on-year up by 39%, quarter-on-quarter up by 12%. PAT for the year is 378 crore, year-on-year up by 53%. ROA for the quarter is 5.8 and ROA for the full year is 5.6%. ROE for the full year is 15.1%. During the quarter, we have crossed the milestone of 16% ROE for the first time post-IPO and ended the quarter with ROE of 16.3% at a leverage of 2.9 times. With this, I conclude and now we can open the floor for Q&A.
Thank you, sir. We will now begin with the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question comes from the line of Varun from Kotak Securities. Please go ahead.
Hi sir, congrats on a good set of numbers. I had a couple of questions. The first one is regard to the Karnataka portfolio. There appears to be a decline in the portfolio in 4Q. Is it because the e-Khata issue has not been settled yet, or are there any other issues you are seeing? The second is with regard to collections. While overall collections are good and you have reported significant decline in GST as well, are there any trends you are seeing in Karnataka, Tamil Nadu or MP, these particular states, whether the collections have improved, where they are up compared to last year or last quarter? And third, I had a data keeping question that you've already given the breakup of fixed and floating loans and borrowings. I just wanted to break up on the benchmark that they're linked to. Thanks.
Thank you, Varun, for the questions. I'll go one by one, and maybe I'll request a question to repeat in between because there are 2-3 questions together. About the Karnataka, we have portfolio of around 6.5%. There is a slight dip of some 20-30 bips. Obviously, these are the reasons which you know very well in the market. Thankfully, India shelter distribution portfolio has been spread across country in a very, a formative way, so that there is no impact in any case. Ups and downs does happen basically. So yes, these are the few challenges which are obviously going to come when you're in an operational business. But otherwise, there is no major impact on that side. So I think we'll be able to cover as the time keeps, building up in the future also. So today we have around 6%, 6.3% of portfolio in Karnataka. You asked some second question regarding some collection piece. Can you repeat it, please?
Yeah, just that overall collections are looking fine, but are you seeing any issues in Karnataka or Tamil Nadu or MP, especially given that Karnataka and Tamil Nadu have this ordinance or bill coming in to effect?
This Tamil Nadu piece came very recently. Even in Karnataka, if you see overall, there is a decent traction. Yes, they may have missed a little bit of target here and there as keep closing, because there's always challenges which does happen when any shift happens in the operational activity. But accordingly, we keep preparing ourselves and growing around. So nothing to worry on that side. Like Karnataka, where we have a 6% of portfolio, same in Tamil Nadu, we were around 5% of portfolio. So we doesn't think there is anything which is challenging and worrisome for us around that side.
And coming to your question on this benchmark about the portfolio, our portfolio is linked to our PLR, which is variable rate. And coming to the liabilities, on liability side, 30% of our liabilities are linked to RBI repo rate or the T-bill. And then about 55% of the borrowings are linked to MCLR. Out of the total 55%, 20% is linked to 3 months, and remaining 80% is linked to the 1 year or 6 month MCLR. And remaining about 15% is fixed.
Thanks, sir. Those are my questions.
Thank you. The next question comes from the line of Raghav Garg from Ambit Capital. Please go ahead.
Sir, thanks for the opportunity and congrats on this quarter's numbers. Just 3 questions from my side. One is on the fee income part. So apart from the processing fee, if I look at the other fees and commission line item, that has grown quite substantially this year. So what is driving that?
So, Raghav, the processing fees that we get on our loans disbursement get amortized over the period of the loan and comes under the head of interest income. So coming to the rest of the fee and commission income, the larger portion of the income is coming by way of cross-sell on the insurance. And then, part of the income is coming from foreclosure of loans, and then there's the routine servicing of the loan. So as you may be aware that during the Q1, we have got the, our corporate agency license. So, as the license income has got stabilized now, so you are seeing some spike in the overall commission income.
Understood. The second question is on assignment margin. So it appears that the assignment margin dipped this quarter on a quarter-on-quarter basis. Is it because you may have done more of HL assignment this quarter than non-HL? Or there's something else to it?
So as a matter of policy, we only do lab direct assignment transactions. But, the margins depend on various factors, that what is the residual tenor of the loan that we have sold, what is the seasoning, and what is the ROI of that underlying loan. So this is that, the margin income comes up, it completely depends on the underlying pool. But there is no change in the strategy HL and lab.
And what's your expectation of reduction in funding costs on a full year basis in FY-26 versus 25?
So as we have said that about 30% of our total funding is linked to the repo rate and T-bill. For that, we will keep getting the rate benefit on an immediate basis. But for the rest of the, larger portion of the borrowing, which is linked to MCLR, the benefit will keep coming in a staggering manner, and it will depend on how much the pass on that the bank will do on the MCLR cut. So, if the 50 basis point rate cut has already happened, we have already got a 10 basis point cut. So maybe, another 10 basis point may be there in 3 to 6 month kind of time. And rest will dependent on the cut in MCLR.
When you say 30% linked to repo or T-bill, you are saying including assignment, right? The funding mix that you give in the presentation, or is it the on-book mix only?
Generally, it is similar on the on-book and the DA side.
Okay, sure. Thanks. That's all from my side.
Thank you. The next question comes from the line of Shreya Shivani from CLSA. Please go ahead.
Yeah, hi. Thank you for the question. branch
I'm sorry to
vintage.
interrupt, Shreya. You're not quite audible. Could you please move to a place where there's good network? Thank you.
Is this better? Hello?
Much better, yes.
Yeah. So my question is on the new branch addition, and you also give out a metric on AUM per branch of, your vintage up to 1 year, 1 to 3 year and all of that. So clearly the new branches that you've been adding, the AUM per branches has picked up quite a bit over there, particularly in 4Q. Is this more of a function of the new branches that you've opened are more in tier 1, 2 cities than in smaller cities? And also, so the reason I'm asking this is because the 1 year's AUM per branch has sort of remained range bound in the past 6 quarters of numbers that you've given out, but the new branch addition seems to have much better AUM outlook. Can you help us understand that?
Yeah, so as an experiment, what we did last year, most of our branches got open in the first quarter itself. That I think if you see, go back on the data side also, quarter one we try to open the branch as per the plan that time. And by the time we covered 3 quarters, I think that has picked up. There's no strategy about opening branches in tier 1. We still not very gung-ho about the tier 1 markets, typically when we talk about affordable housing, the segments that we are catering around that side. It's only that we, prepone the plan instead of staggering across the year. We did this experiment last year, and I think it worked a little bit, and that's helpful around that side.
Sure, understood. So the new branch, so the new 40 to 45 guidance that you've given for branch addition, that also you'll do in a similar manner going ahead?
No. This year we are making some different changes. There is always, every time you have to see some ways how it can be more effective. That's the internal strategy. But overall, this year again, we're going to open around 43, 45 branches. So different way of staggering it. So it's not like last year, but maybe we come up with a better idea this time. We'll convey as and time get progress and the things comes into the experimentation form.
Got it. That is very useful. Thank you and all the best.
Thank you.
The next question comes from the line of Aman from Phillip Capital. Please go ahead.
Hello, sir. Am I audible?
Yes.
Hello. Yes. So, sir, congrats on a good set of numbers. So, one question is on the repayment rates. So, if I look at your repayments rate, they have climbed up sequentially, right? And you also mentioned of some foreclosures. So, could you give us a sense on as to why? I mean, is it because of some competitive intensity that we are seeing in, or is it something of a seasonality? Some clarity on that would be really helpful.
So, while calculating the amortization rate, you might not have been considering the impact of co-lending that we have done. So, co-lending portfolio that we originate for the banks, we don't consider that as a part of AUM. So, we will have to factor in from the disbursement number while computing the amortization rate. It is better than last year, in fact.
Okay, got it. And so secondly would be on the co-lending part of our book. So we are at 57% housing loans on a portfolio level and about 43% on the loans against property, right, LAP. And that is where we, I assume, do most of our DA business, direct assignment. Now, isn't this a bit aggressive from a housing finance company standpoint? I mean, is that something of a risk that we see down the line wherein RBI might come down on you that, okay, you're being too aggressive in the LAP portfolio?
So if you look at our overall AUM, you're yes that our housing loan portfolio is at 57%. But if you look at the on-balance sheet portfolio, so as you have rightly said, that for direct assignment, we do it for LAP portfolio. So at the on-book balance sheet level, the proportion of housing loan is at about 67%. So we are, well compliant with the RBI regulation on this particular PVC criteria.
But any plans on maybe running down this book a bit or maybe, slowing down disbursements in the LAP portfolio?
So I think let's see that way. Instead of slowing down LAP portfolio, we'd always insist on taking up a SL portfolio. So this 57% eventually it tweaks to respected level of some 60-61%. So that things are very well taken care of in full threshold form. So we're not pulling down LAP, but it definitely will take up a SL. We have a plans around that side. So as a quarter progress, you'll also see around this piece.
Perfect. And so one last question, if I may. So my last question would be on the competitive intensity, right? So we have seen a lot of your bigger players also getting into the affordable market, right? So how do you see that affecting you? Or maybe if you could just elaborate a bit more on what is our right to win in such competitive markets. I mean, Rajasthan being one of them. So just some clarity on that would be helpful. Thank you.
Well, we are a player of tier 2, tier 3 markets basically, which is a deep down into geography. Maintaining our ticket size, which is 10 and 11 lakh rupees of ticket size. And sourcing is through our direct teams instead of depending upon third party channels. And this is a quite, operational extensive activity around that side. So to build this DNA, you require thousands of people, hundreds of branches, and then focusing on this market. So large players do have the tendency to take the business to next level instantly, which they do. So the replicating this model becomes a little difficult. So the way we serve, you require to come to this level around that side. And this is the way we are acting it. We are into business from last 15 years and so many players keep coming around, big and small, all kind of that. Everyone has to find their own forte accordingly. So we are...
Got it, sir. Thank you. That answers my question and all the... Thank you.
Thank you. The next question comes from the line of Aditya Pal Jaggi from MSA Capital Partners. Please go ahead.
Hello, am I audible?
Yes, you are.
Right. Thank you so much. Sir, great set of performance. Just wanted to quickly get a few data keeping questions. That is, how much would be a 1+ DPD? And what would be a total gross write-off for FY25 for the whole year, for this quarter, and the collections of our earlier write-offs for this year and this quarter?
Can you repeat the question? There's some... Hello?
If you look at our DPD1, it is at about 7%. And we have done a write-off of about 8 crore this year. But however, we have parallelly recovered about 6 crore from the loans that we have written off in the previous years. So there is no material impact of write-offs in the credit cost this particular year.
Understood. So Andhra Pradesh and Telangana from the last 3 years have really performed well for us. So what is the strategy or what is working for us over there? And how do you think about this market, say, in the subsequent years? And another question on this strategy is that how are you thinking about state-wise AUM growth for FY26?
So it's not a one state specific focus we have. We are spread across these 15 states. Being a new geographies for us, Andhra Pradesh, Telangana, compared to the other one like Rajasthan or Maharashtra or MP, I think, being a small base, that looks a good output in that sense. If you see in South, we are spread across 4 states, AP, Telangana, Karnataka and Tamil Nadu. Karnataka, Telangana, we are having some AUM of 5-6% there. And here we are currently around 4-4.5%. So with time, you'll see the progress across there basically. It is not a state specific. Yes, there is a good productivity which is coming from AP, Telangana also. Obviously, that is the thing which is pulling up their numbers simultaneously.
Understood. And so, what would be a district penetration in states like Rajasthan, Maharashtra, Madhya Pradesh, and then what would be a market share in these geographies?
Look, we don't compare with in terms of what is my market share and all. Reason being, mortgage housing is a humongous business which is staggered into various ticket size, various forms in that sense. We play in a ticket size of 10-11 lakh rupees. There are competition which are affordable, playing between the other set of ticket size simultaneously. And overall housing is a very big gamut around that side. So we see our continuous growth, and as we see compared to the last year, there is a continuous growth in Rajasthan and rest of the states also. Rajasthan, we still have a highest AUM, which is in range of 30-31%.
Well, and sir, just last question. So, our stage 2 plus the GNPA does not match a 30 plus DPD. So intuitively, the 30 plus DPD should match a stage 2 and GNPA.
Yes, you're right. Yes, you are right. So there is some impact of the restructured loan that we have done during the COVID 1 and 2 schemes. So impact of the same is about 15 to 20 basis point between the 30 plus and the stage 2 plus stage 3.
So that is the delta that is coming in there. That is the restructured book.
Yeah.
Understood. Yeah.
Which is actually stage 1 asset, but this is the conservative philosophy. We have considered slightly higher provision on that and consider that as a stage 2 asset. But that book is doing fine now.
All right. And so, what would be a difference between unique customer collection? You've given overall collection. What would be a unique customer collection?
So unique customer collection is at about 97% plus.
Understood. Thank you so much and best of luck to the team.
Thank you.
Thank you. The next question comes from the line of Shripal Doshi from Equirius Capital. Please go ahead.
Hi, sir. Good morning, and thank you for giving me the opportunity. And congrats on a good quarter, and I really appreciate the detailed presentation. My question was on GS3 coverage. So if you look at that number, is closer to 25%. However, as we deepen our penetration in the existing and the newer states, do you see this 25% inching upward? Because if you look at some of the larger guys are having a much better PCR on GS3, ranging between 50 to 60-65%. So do you see this 25% inching upward, and what is the credit cost that we are comfortable with?
So you need to differentiate between us and any other prime housing finance company. So while we underwrite the loan only against the self-occupied residential property, and average LTV of the portfolio is close to 52%. So if you go over the historical number which are available for more than 12 years now, so the LGD that we have seen on our portfolio is close to 11-12%, including principal and interest. So the PCR of 25% that you are seeing on stage 3 asset is actually 2x of what the actual provision is required. So based on the management overlays and all that, we have been able to pull up this PCR to about 25%. That we feel is sufficient for this kind of business that we are doing. And on the overall credit cost, including the growth on the stage 1, stage 3 asset, which is currently running at about 30-35%, we are comfortable with about 40 to 45 paisa overall credit cost on the P&L.
Got it. But sir, your LGD of 11% seems much controlled than some of the peers. But the idea is that as we scale up and deepen our penetration, do you see this inching up, or as a business model, you believe that this is what it should be, closer to 25%?
So we have seen the last 5-7 year trend in the LGD. This remain broadly in the range of 10 to 12%. So in case the actual trend reflects some uptake, then probably we will increase our ECL provision as well. But in case not, then probably we will continue with the current number.
That will go as per the model on the ECL, which works around that side.
Got it. And in terms of customer profiles, have we when we add newer branches, are we also able to see newer customer profiles being onboarded in our system in terms of underwriting them, or in terms of filtering yes and no in those customer profiles?
We are largely getting the self-employed customer in these markets of tier 2, tier 3, and which includes all set of gamuts on the customer who are serving this vicinity. Obviously, we also have a list of negative profile which we don't want to touch basically, and that you can get as and when you want. So this is a matter of policy for us. So we are very clear this is the market which we have to service. If you see, we have not changed any large ticket size or things around that side. We continue to work between 5 to 30 lakh rupees of ticket size and majorly into affordable mortgages. So it's nothing new that which has come up around it basically, because the set of customer who should have a collateral or property to offer in the same vicinity. So I think that gives a clear-cut visualization of the questions that you are asking for.
Got it, sir. That is helpful. Thank you, and good luck with the next quarter, sir.
Thank you.
The next question comes from the line of Miten Latia from Fractal Capital Investments. Please go ahead.
Good morning, sir. Uh, the uh, the broader cohort that you mentioned, sticking to tier 2, tier 3, maintaining a 10 lakh rupee ticket size, direct sourcing, is that maintainable all the way to 30,000 crore of AUM, or do you think along the way we'll have to tweak this to get to that number?
So there will be always as the market is growing, your inflation is growing, the cost of construction is going, this 10 lakhs will obviously go up, but the step by step. It's not an overnight change of shift of gear on that side. If you see 6-7 years back, the ticket size used to be 6-7 lakhs. Today it is 10 lakh rupees. As we reach towards this another 4-5 years, you can see that this is going up, and this may by that time will go to the 14-15 lakh rupees of ticket size also. But yes, we want to continue to work in the affordable housing segment. Any new opportunity in terms of product opening, we always welcome into that piece. But it has to be very well taken care of risk adjustment businesses basically, not like just for the sake of doing it. So we'll be cautious, but yes, we'll be eager for growing ourselves.
So sorry to re-emphasize, but up to 30,000, it will still be a direct sourcing model. You don't see a need to change that.
That will be our prime model. In case if you have to come with the new models, then definitely we're not going to disturb the current one basically. We're not going to overload our current set of teams who will be basically shifting from a direct sourcing model to some new model, because of the expertise which this team has developed with time basically.
Great, sir. Thank you.
Yeah.
Thank you. The next question comes from the line of Sonal from Asian Market Securities. Please go ahead.
Yeah, thanks for the opportunity and congrats on good set of numbers. So I had two questions. One is on this fee and commission income. So if I look at it as percentage of assets or on disbursements, this number has inched up quite significantly. Now, just few questions here. If you could just help us with the breakup, how much is the insurance income, in this fee and commission income? And second is, how many insurance companies have you tied up with? Do you also provide any insurance loan to the end customer? That is my first question. And second is, with focus shifting to floating rate advances, how do you see yields moving from here?
Yes, Sonal. So, if you look at the breakup of the total other income or the fee and commission income, so about 50% of the income is coming by way of cross-sell. And while giving the, insurance, we also fund the customer loan in case we want to do that. And remaining about 20% of the income come by way of, foreclosure charges on the loan. And remaining 20% comes on the, loan servicing fees in the form of bounce charges, cash handling charges, etc. And remaining 10% of the income comes from the co-lending fees that we are doing. So on the co-lending loans, we get upfront fees, share on the processing fees that we charge from the customer.
Sure. And so just one more clarification here. So you said that 50% income is coming from cross-sell of insurance. So, whatever loans we've disbursed during 4Q, so if you could just indicate how many, customers or borrowers have kind of opted for insurance and probably how many of them have we funded during the quarter?
Sure. So, we do primarily two types of insurance. One is property insurance, wherein, we see a good penetration rate, wherein more than 90% of the customer go for the insurance. And another is credit life insurance, wherein we see a penetration of upward of 80%, wherein, customer go for the credit life insurance for about 5 to 7 year basis their behavioral expectation of the loan. And, coming back to your old question, so we are working with about 4 insurance companies for the life and the property insurance.
And sir, on the floating rate advances, I understand you'll be able to maintain your 6% plus spreads, but how do you see the yields moving from here?
So floating rate loan that we have said that is constituting about 45% of the portfolio. So on that portfolio, there is a structure that, the loan is like a semi-variable kind of structure wherein it is fixed for some initial 3 years period and then it is variable. So these loans are linked to our own PLR, basis the cost of fund and the OPEX of the company. So as and when that will change in the future, probably we may pass on some benefit to the customer as well.
But at the initiation of the contract, could you just help me with the difference between what will be charged during the fixed rate period and what will be charged during when it becomes floating rate or variable rate?
So the rate is similar. It's not a teaser loan like kind of product wherein the initial rate is slightly lower and the subsequent rate will be higher. It's a a flat rate of product wherein customer rate remains fixed for initial 3 years, and this is the moment after 3 years the customer rate might change in future.
Sure. Thank you, sir.
Thank you. The next question comes from the line of Janice Chedda from Kempfin Family Office. Please go ahead.
Good morning, sir, and congrats on the good set of numbers. Sir, when you talk about this 30,000 crore AUM by March 30, what will be the ROA by then? Since on scale, do we expect a dip in the ROAs?
Yeah, so our ROA is currently about 5.6% for the year, but our leverage is close to 2.9 times. So as the leverage will increase from here, our ROA will moderate from here. So we expect that down the line, 2 years from here, we will be touching close to 4x kind of leverage. At that point of time, you will see some moderation in ROA close to 4.5% that you could expect.
Okay. And I'm assuming this 30,000 crore will not require any additional equity raise?
It would require eventually, I think, but I think it will take another 3 years to reach there. We're talking about 30% in 5 years of time.
Understood. Yeah, thank you so much. That's all from my side.
Thank you. A reminder to all participants, you may press star and 1 to ask a question. The next question comes from the line of Rohit, an individual investor. Please go ahead.
Hi, am I audible?
Yes, you are.
Hi, good morning, sir. Congratulations on a great set of numbers. I had just one question. What can be the trajectory of ROE going forward, sir, for the next 2 financial years, FY26 and FY27? That's my question. Thank you.
So as we have said that, so in the previous question that currently our ROA is at about 5.6%. This is the low leverage of the company. So ROE is a function of, ROA and the leverage. So as we will progress, our leverage will be increasing and ROA will be moderating. But as we have ended the, Q4 with about 16% plus ROE, you can expect the similar trajectory or the upward trajectory in the coming quarters.
Okay, sir. Thank you. Thank you.
Thank you. A reminder to all participants, please press star and 1 to ask a question. The next question comes from the line of Renish Bhuva from ICICI Securities. Please go ahead.
Yeah, hi, sir. Just 2 questions from my side. So one on this LAP portfolio, right? So of course, you've been growing this portfolio at almost 30-35% plus over last 2 to 3 years. And given this audience in TN and Karnataka, do you foresee any disturbance in collection in LAP portfolio, at least as of now?
I think not exactly as of now you talk me. We are just taking the stock of situation regularly on that side. So if you see current state of affair, we can't see instantly some kind of jitteries around that side. So, but yes, we are cautious about if anything happens, we'll be first to come back to you on this.
Okay. And sir, would you like to share the overlap of LAP portfolio with MFI customers?
I think it's around 3.5-4%, but this is a very old customer we're talking about. We did our scrubs done basically, a quarter back or so basically. And largely when we see the delinquency ratio also, there's no very large spot around that side. It's a range bound again.
Okay. So 3.5 to 4% of LAP book or a total book?
It is a total book.
Okay, it is of total book. Okay.
Yeah.
Got it. And sir, secondly, in this the next phase of growth, wherein we are sort of planning to reach 30,000 crore by March 30, and when we look at the geographical concentration or presence, we are still at 30% plus in Rajasthan. So going ahead, which are the key states which will sort of drive the growth for us? And where do you see the share of Rajasthan settling maybe over next 2 to 3 years?
I think with the progress of time, every state starts performing in that sense. And Rajasthan is still a flagship zone for us and delivering a wonderful numbers in that sense. Though they'll continue to maintain their momentum, typically on a disbursement side, but that's definitely because of the impact of other states growing and they're settling down. There'll be more growth coming from those states. I feel this will start trickling down, and in another 4 or 5 years, they'll come less than 25% if you talk about Rajasthan per se, basically. If you ask the other state which is coming around, I feel good scope in South, all 4 markets typically, right, as we see that. Consistency you can see both in Maharashtra and MP, and new things, green shoot you can see coming from other states like UP or Haryana in some case, basically, that you can see around.
But, okay, so would you like to spell out any, let's say, 2-3 markets where we are focusing more incrementally?
I think we should not distract because of we are focusing in one market or the other. For us, all are the clear-cut distinction. We chose a market keeping in mind the objective of, giving this affordable housing. Obviously, quarter on quarter will be showing the numbers. And because of that, when we focus it, if you see the India shelter philosophy always is there, any branch which has to be opened, it should be very well controlled from the centralized team. So we have spread our distribution in such a way. And the system works in such a way that there should be distinction between the 2 markets because of the reasons that we feel that this is a good market or the people are not good or something like that. So we are quick around that piece where the changes need to be required to bring the opportunities enough in the market which are available there.
Got it. And just a last bookkeeping question. So what is the disbursement yield and incremental cost of fund?
So disbursement yield are currently at about 15%, and our incremental cost of fund for Q4 was about 8.6%. So that was having some element of NHB funding as well. But on a stable state, you can say that our incremental cost of fund is also at about 8.7%, excluding NHB, which is similar to our average cost of fund.
Got it. And maybe just the last question on the sourcing side. So, sir, let's say as on March, of what percentage of disbursement is through branch sourcing and what percentage would be non-branch sourcing? When I say non-branch, is basically connected DSA, digital marketing, etc.
So if you see entire things act from branch in terms of servicing the customer. The fraction of digital is growing up basically since we keep working the venues. But ultimately all these leads and customers is being passed on to branches basically. So branches are there to serve the customer. So digital piece is picking up for us basically. Where the new venues which are coming around that side and still in the experimental phase. So we have not commented much on the numbers around that side. So there's definitely that traction also start building around that piece.
And DSA connector is practically zero for us as of now, right?
So from branch side it is not. But yes, through digital, if we have a certain aggregator who are providing the leads, that helps us out some way basically.
Okay. Thank you, sir, and best of luck.
Thank you, Ramesh bhai.
Thank you. The next question comes from the line of Mona Khetan from Dolat Capital. Please go ahead.
Yeah, hi, good morning and congratulations on a strong set of numbers. I have 2-3 clarifications. So firstly, what is the share of cash salary, if at all we have any exposure there?
I think
Hello? Yeah.
The recent disbursement of cash salary is quite minimal. But overall, if you see among the salaried profile, what we have today, we have around 20% of salaried profile, around 8-9% constitute of the cash salaried out of it basically. But as of now, we are majorly focused on formal salaried wherever we are doing in a smaller markets also.
Okay, so 8-9% of the AUM.
Of the salaried piece.
Okay, of the 25% of salaried.
Yes.
Okay, got it. And secondly, just on the co-lending bit, so just wanted to understand this piece a little more. So is the 20% of the book that comes at your end, is it yield dilutive or is it at the same yields? And also on the OPEX bit, does the entire OPEX for the 100% of the loan come at the NBFC's end, or how is it sort of distributed?
So in case of co-lending, we are doing like CLM2, wherein the customer is getting the same yield as we are doing it on our own book loans. But having said this, we are booking only 20% of the loan portion, wherein we are getting slightly higher interest income. So, but one side there is a higher interest income, but correspondingly on the expenses side, we are also getting the expenses to the extent of 100% of the share. So that is matching at the PAT level. So the PAT is similar whether we do the co-lending or whether we not do the co-lending. It's it's one of the avenue of funding that we that we do. So at this point of time, co-lending is at about 4% of our total AUM. So that's how the position is.
Sure. And so the effective yield, I understand it's higher than the overall, but the effective yield, is it higher than your 14% or so of yield on the book, or is it lower?
So like we do only the LAP loan, so this particular co-lending product. So our average LAP yield is at about say like 15.5%, and the LAP yield to the co-lending loan will be the similar range of 15 to 15.5%.
Got it. And just finally, in your loan mix, what percentage of loans will have above 80% kind of LTV?
We don't do 80% like above LTV. So there will not be any loan wherein the sanction LTV is above 80%.
Okay. So it's almost nil or so at your end.
Yeah.
Got it. Thank you. Thank you so much.
Thank you. The next question comes from the line of Chinmay Nema from Prescient Capital. Please go ahead.
Good morning, sir. I just wanted to follow up on the previous questions related to leverage. You guided that leverage could go up to 4 times in 2 years' time. I just wanted to understand if there can be any regulatory challenges in increasing the leverage, and also from a long-term perspective, how do you see leverage increasing, or where do you see it peaking out as the AUM grows?
So there is no regulatory challenge on the leverage side. Regulation allows you to maintain 15% CRAR. That effectively means leverage upward of 9 times as such. So, but when we speak to the credit rating agencies, the bankers and all that, they are comfortable with a leverage up to 5x kind of number. So our brief thought process is that once we start touching 4x kind of leverage, then we'll start working on the equity raise and probably try to close the equity before touching the 5x kind of leverage.
Got it, sir. Understood. Thank you.
Thank you. The next question comes from the line of Raghav Garg from Ambit Capital. Please go ahead.
Sir, thanks again for the opportunity. Just 2 more questions. One is on attrition. How was it for you in FY-25? Has it come down compared to last few years, or is it still a problem? And what are you doing to control it?
So compared to last year, there is a improvement in attrition, but not to our level of satisfaction. That is one thing. Attrition is still a challenge on that side. Particularly for controlling this attrition, I think board has been kind enough. They have just approved the next tranche of stock options, which is going to cover the large set of people. And I think to the extent which is earlier we were having around 25% of the employees above frontliners who are covered into that side. This will take to the next level basically. So this is something board has come up and will bring this as a traction for the people to run along with us basically. So we are just going to formalize it, and once it is done, we'll also convey you around that side.
Understood. Thanks. And I'm also trying to understand your branch expansion and hiring strategy. So when I look at FY24, right, these activities appear to have been spread out through the year. In FY25, you seem to have upfronted branch openings and hiring, during the year in the first half. Can you share some thoughts on how you'll execute in FY26 and why you believe it's a better strategy?
I think since it hasn't been executed, I won't say better strategy or not. I simply said that there will be a new experimentation that will going to come back to you basically. So we are just in a process. As it completes, we'll definitely showcase ourselves, how it's worked, like as what we did in the past also. But yes, that's what I can assure you. We'll be again opening around 40-45 branches this year again, basically.
Just one more follow-up to the previous question on attrition. So you said you plan to give ESOPs at the branch level. Is it an effective retention tool, you think? Because I would assume generally, salaries and something which is more tangible appeals more to the staff at the ground level. But happy to hear your thoughts on this.
So best practices in the industry, the stalwart of the industry leaders you talk about in the history. I think this has been a good tool for retention, typically for the quality resources in the system. I think that worked well in the past. There has a history towards that side, basically. So yes, retention is something which you can't, ignore it, and you can't say simply that it can be zilch at one point of time. But these are the objectives, these are the tools which actually definitely pull the right set of people, the quality people who look for a long term and can, align with the vision of company. So this is an important piece. But this is one of the important tools, what we feel confident about, that should help us some way. But one side the board is also kind enough, and other side this will look as we do the, what you said, feedback from the employees on the line, and we try to align together. I think let's see how it turns on that piece, but we look optimistic as of now on that side.
Thank you. That's all from my side.
Thank you. Ladies and gentlemen, that was the last question for today. I would now like to hand the conference over to Mr. Rupinder Singh for the closing remarks.
Thank you everyone for taking your valuable time for attending our earnings call. An audio recording and the transcript of this call will be uploaded on our website in due course. Looking forward to hosting you all in the next quarter. If you have any further questions or require additional information, please feel free to reach out to us. Thank you so much and have a nice day.
Thank you, sir. Ladies and gentlemen, on behalf of ICICI Securities Limited, that concludes this conference. You may now disconnect your lines.